Can you imagine having to pay 56% in taxes on not just your regular income, but gains from your investments as well? What about having to pay taxes on real estate gains every time you want to upgrade? In the last couple weeks, Biden has come out with a couple proposals to do exactly that. The first proposal will see some people's capital gains tax rate almost double to 39.6%. And the other proposal would shake up the 1031 exchange that lets you upgrade your real estate investments and defer your taxes, and in some cases defer them permanently, but more on that later. So in this video, we'll be going over all the key details you need to know about these two proposals, how the wealthy have been using these laws, and give my thoughts on how these proposals would affect the economy and how likely these will pass. Hey, I'm Kevin, and on this channel, we talk strategies to help you along on your financial journey. If you want to know how your tax bill could be affected in the future, let me know by hitting that like button and let's get started. So today, there's two types of capital gains. There's short-term capital gains and long-term capital gains. Short-term capital gains are the profits you made from selling an asset that you've held for less than a year. These could be things like stocks, land, businesses, and more. And all these short-term capital gains are taxed at your regular income tax bracket. On the other hand, long-term capital gains are profit you made from selling an asset that you've held for longer than a year. And these gains are taxed at the long-term capital gains tax rate, which are either 0, 15, or 20% at the top income bracket, which differs from your typical tax bracket that could range from 10 to 37% at the top. For example, let's say you made $500,000 from a job. This would be taxed at your regular income tax bracket, which is about $164,000 of taxes. Similarly, if you invested in the stock market, bought some stock, and sold it within 1 year and made $500,000, again, you'd pay the same $164,000 in taxes. But if you invested in a stock market and sold the asset after 1 year and 1 day and earned $500,000, that would be long-term capital gains, which will be only taxed at 20%, meaning you'll only pay $100,000 in taxes. Yes, that 1 day is saving you a ton of money. Now, there's a couple reasons why long-term capital gains is lower than your typical income tax. First is that usually the money that you put into these type of investments are earned from a job where you already got taxed. So it doesn't really make sense to double tax at that high rate. If you want to know how to avoid taxes on your gains altogether, check out my video on IRAs up in the top right corner. And the second reason why long-term capital gains are lower in taxes is to get people to reinvest into the economy, invest in the long term, and keep the economy growing. I mean, if there's no difference between long and short-term capital gains, then there's no real incentive for people to invest for the long run. Alright, so now that you know the basics, what could potentially be changing? So the proposal would see that anyone earning more than $1 million will have their long-term capital gains tax rate go from 20% up to 39.6%. This is not including the 3.8% tax on any investment income, as well as any state taxes. For example, if you live in California, you could be paying the 39.6% plus the 3.8% plus state tax, bringing the total up to 56.7% in taxes. If that happens, good luck trying to buy property in states that have no income tax, because a lot of people may be moving. So using the same example as above, if you earn $500,000 in the stock market and you held the stocks for more than a year, instead of paying just $100,000 in taxes, you'd be paying almost $200,000 instead. That's a big difference. I mean, you could say like, who cares? This is only affecting people who are earning over $1 million already, all the top earners, and won't affect people like you and I. But that may not be true. This will be a big shift, changing the way we tax people, where if this passes, investment income will be taxed at a higher rate than earned income through work. This will lead to a lot less reinvesting in the economy. Without the difference of short versus long-term capital gains, it could also disincentivize people from even thinking about things in the long term. There's definitely a trade-off with this because with the taxes, you'll have more money going back into the public and building infrastructure, but then businesses will have less money to reinvest in themselves and innovate. And along with the potential corporate tax hike of 21% up to 28%, that will just magnify the effect on these businesses. I think when and if the date is announced that this type of bill would come into effect, there would be a huge sell-off in the markets as everyone tries to cash in before this takes effect, leading to a big bloodbath in the markets. Now, with all of that said, people could just invest elsewhere, like in real estate, right? Because there's ways in real estate investing to minimize your taxes, right? Well, that brings me to my next point, which is the shakeup to the 1031 exchange. Okay, so one of the major benefits of real estate investing is because of the 1031 exchange. This is a tax law that lets you defer taxes on investment property as you exchange it and upgrade to a like-kind property, like another house. Let's go over an example. Let's say you bought a house A for $500,000. Then it appreciated to $1 million. You'll have a $500,000 gain there. Now, what if you sell that house and you buy a $2 million house? With the 1031 exchange, instead of having to pay taxes on those $500,000 of gains in the first house, you could actually defer it and roll it into the new house and not have to pay those taxes until you eventually sell that house, which will trigger a tax event going all the way back to the beginning. You could do this over and over again without a limit. But, and this is a bit dark, but once you grow old, 100 plus years old or something and pass away, and someone like your kids inherits your property, they actually get a stepped up tax basis. What this means is that, let's say from the very beginning, you bought a $500,000 place and you kept using the 1031 exchange to get a bigger and bigger property. And let's say you got a $10 million property at the very end. Instead of having to pay taxes on the $9.5 million of gains, when your kids inherit this property, that cost basis gets stepped up from the original $500,000 up to the current $10 million, meaning they don't have to pay the taxes. From there, they can do whatever they want with the property, including 1031 exchange it to even higher price property. But all in all, the cost basis is now set at the $10 million, not the $500,000 from earlier. Now, a quick note is that this 1031 exchange is only for investment properties, not your primary residence. In that case, you'll have section 121, which says that if you've lived in a property for 2 of the last 5 years and then have capital gains on it, up to $250,000 of capital gains if you're single or $500,000 if you're married would be tax-free. And you could do this once every 2 years. So with all of that said, what could be happening to the 1031 exchange? Well, 2 things. 1, capping the tax-free profit to $500,000, and 2, getting rid of the stepped up tax basis. On one side, you could see that doing this would put a lot of money back in the government pockets from tax money. One estimate has the savings of the $500,000 cap at $41 billion in a 4-year time period. But if we take a step back, this could potentially have a much wider effect. With these type of gains being taxed, it could potentially drive people to hold property for longer, which would mean that the supply would drop in an already hot real estate market, driving up the prices. And then when you think of big corporations, instead of buying like a $5 million building and having that appreciate and potentially crossing the $500,000 threshold, they might opt to buy 10 $500,000 places again, because the $500,000 cap is per property. That means these big players might start to creep into the lower end of the housing market, which is where people like you and I are trying to buy homes at, and lower the supply and again driving up the prices. And lastly, you know that 5 to 10% of fees and closing costs you have to pay every time you sell a place? Well, all that money is being earned by someone and being taxed somewhere. So with less people buying and selling places, there'll be less of those fees and costs to pay. And that would in turn have less money flowing back into the economy. Now, we don't know if that would offset any tax gains that the government will get for just taxing this in the first place, but only time will tell. Although again, if a date for this does get announced, then you'll probably see a bunch of people trying to sell their places before this takes effect, which will probably lead to a temporary dip in the housing prices. So with everything that we've talked about, what are my thoughts? Well, I think it's probably very unlikely that any of these bills would pass as is. And it's more of a shoot for the moon and land among the stars type of thing, where you give a really high number so you have room for negotiation. Maybe instead of doubling the capital gains tax rate, maybe it goes from 20 to 25 or 30%. And for the 1031 exchange, maybe instead of capping it at $500,000, they cap it at a higher amount. Or they get rid of the exchange altogether to further even the playing field. And we can't kid ourselves that all the wealthy people who are using these types of tactics right now will just sit around and watch. They'll probably have influence among a lot of different areas, including politicians. And with our economy just opening back up, and with the Democrats being on a fine line in terms of seats, it'll be hard pressed to get every single one of them to agree on this bill. At the end of the day, all the rich people will still have their army of lawyers and accountants to find every single loophole they can have to save them money, something that regular people like you and I don't have. Who knows, maybe in the next couple of years, more proposals come out to make things better or worse, only time will tell. But in the meantime, did you know that there's already a way where you can put your money to work for you and not have to pay taxes on any of the gains? Well, if you want to know more about it, and especially the mistakes to avoid, check out the video I made on that topic up in the corner. Anyways, hopefully that nicely summarizes the two proposals that have come up over the past couple weeks, and gives you an insight into the tools that the wealthy are using to further grow their wealth. If you watched till this point of the video, let me know in the comments what type of videos you want me to do in the future. And as always, invest safe and see you in the next one.